Imagine a force so powerful it can single-handedly alter the fundamental economics of a global asset. Now, listen to this stunning claim from author Adam Livingston. A single company, Strategy, is synthetically halving Bitcoin. What does that even mean? It means one corporation is buying Bitcoin at such a ferocious pace that it's effectively reducing the available new supply just as much as Bitcoin's own built-in scarcity mechanism, the halving event. This isn't just a market trend, it's a potential market takeover. Today, we delve deep into the audacious strategy of co-founder Michael Saylor. Is he a visionary, building the world's first true financial superpower on a foundation of digital gold? Or is he a high-stakes gambler, leveraging billions in debt to construct a house of cards that could trigger a systemic market collapse? In this video, we will dissect the numbers behind Strategy's relentless accumulation, explore the chilling warnings from analysts about a potential debt-fueled implosion, and ask the ultimate question: what happens to the world of crypto when one company tries to swallow the ocean? To truly grasp the magnitude of this strategy, we must journey into the mind of its architect, Michael Saylor. This isn't merely a financial trade for him. It's a deeply held philosophical conviction. In countless interviews and epic social media threads, Saylor has articulated his worldview. He sees Bitcoin not just as a digital currency, but as the ultimate solution to the problem of monetary inflation. He calls fiat currency melting ice cubes, constantly losing value due to government printing presses working overtime. In his eyes, assets like gold are dinosaur tech, ancient and cumbersome compared to the speed and purity of digital property. Saylor frames Bitcoin as digital energy, pure, unadulterated monetary power that can be teleported anywhere in the world at the speed of light. He argues that in an era of unprecedented global debt and economic uncertainty, the only rational move for any corporation is to convert its treasury from depreciating fiat currency into an appreciating, perfectly scarce asset. For Saylor, this isn't a gamble. It's the only logical safe haven in a world gone mad. He is positioning Strategy not just to profit from a price increase, but to survive and thrive in what he perceives as an impending economic paradigm shift. The story starts not with a bang, but with a cryptic message. After a stunning 12 consecutive weeks of accumulating Bitcoin, Strategy suddenly took a break. For 1 week, the buying machine fell silent. Then, co-founder Michael Saylor took to social media with a simple, almost ominous line: "Some weeks, you don't just hodl." This wasn't a signal of retreat. It was the sound of a predator reloading. And reload they did. Just before this brief hiatus, Strategy executed another jaw-dropping purchase, snapping up 4,980 more Bitcoin for a cool $532 million. Let that sink in. In a single transaction, they spent over $500 million. This brought their total corporate treasury to an almost unimaginable figure: 597,325 Bitcoin. At current market values, that digital hoard is worth over $70.9 billion. This isn't just a corporate investment. It's a treasure chest that would make ancient kings weep with envy. And the market has noticed. Shares in Strategy have climbed over 16% this month alone, a testament to the market's faith, or perhaps its feverish speculation, in Saylor's grand plan. Yet, this high-wire act has a dark side. While the company's stock is soaring, it still trails its all-time high from November of 2024, a subtle reminder that what goes up can, and often does, come down. The relentless buying, the massive numbers, the cryptic tweets, it all paints a picture of a company on a mission. But what is that mission, and what is the ultimate price of this ambition? This brings us to the terrifying question at the heart of this entire saga. Is this sustainable? According to some market analysts, the answer is a resounding no. They are sounding the alarm, warning that this aggressive, debt-fueled institutional buying spree is not only unsustainable, but poses a grave risk to the entire market. They fear it could be the trigger for a systemic market downturn. Think about it. Where is all this money coming from? Strategy has been raising billions in capital, often through debt instruments. And let's be specific about these instruments, because the details are both brilliant and terrifying. Strategy has famously raised billions using convertible senior notes. In simple terms, they are borrowing vast sums of money at very low interest rates. The convertible part is the kicker. It gives the lenders the option to convert that debt into Strategy's company stock at a predetermined price in the future. It's a win-win in a bull market. Strategy gets cheap cash to buy more Bitcoin, and the lenders get the upside if the stock price, which is now almost a direct proxy for Bitcoin, soars. But this financial alchemy has a dark side. It intricately links the company's solvency not just to the price of Bitcoin, but to its own stock performance, creating a complex web of dependencies that could unravel spectacularly if the market turns south. This strategy works beautifully in a rising market. As the value of their Bitcoin holdings increases, the debt seems manageable, and their balance sheet looks stronger than ever. But what happens if the market turns? What happens if the price of Bitcoin experiences a significant and prolonged correction? Suddenly, the value of their primary asset would plummet, while the mountain of debt they used to acquire it remains unchanged. This could create a death spiral. A falling Bitcoin price would put pressure on Strategy's ability to service its debt, potentially forcing them to sell off some of their Bitcoin holdings to cover their obligations. But selling a massive amount of Bitcoin from a hoard that large would itself crash the price even further, increasing the pressure and forcing more sales. It's a feedback loop from hell, a contagion that could spread like wildfire through the entire crypto ecosystem. This is a high-stakes gamble that could either reshape finance or bring it all crashing down. If you're finding this deep dive into the crypto world fascinating, hit that like button to let us know. The danger isn't just theoretical. This isn't just about a potential forced liquidation. The mere existence of such a massive, concentrated holding creates a permanent psychological overhang on the market. Every trader, every analyst, every retail investor knows that this colossal Bitcoin whale is out there. Any move they make, or are even rumored to make, sends immediate shockwaves through the ecosystem. This centralizes influence in a network that was fundamentally designed to be decentralized. It inadvertently creates a single point of failure, a Saylor premium or Saylor discount that can move prices, completely detached from the asset's fundamentals. It's a paradox. The man who champions Bitcoin for its decentralized nature has, through his very success, become a centralizing force within it. This concentration of power is a source of both comfort for bulls who ride his coattails and profound anxiety for those who fear that the fate of their investment is now tied to the decisions of one man and one board of directors. A forced liquidation from Strategy would be a cataclysmic event, wiping out not just institutional players, but countless retail investors who have put their faith and savings into the promise of Bitcoin. So while Michael Saylor's vision is bold, the risks are equally monumental. He is walking a tightrope between becoming a financial legend and potentially becoming the catalyst for a crypto winter colder than any we've ever seen. But to truly understand the scale of what's happening, we need to zoom out. Michael Saylor isn't alone on this quest. He's just the biggest and loudest player in a much larger game. A new class of entity has emerged, the Bitcoin Treasury Company. These are public companies, private enterprises, crypto firms, and even some government organizations and pension funds that are now treating Bitcoin as a primary reserve asset. And while Strategy is the undisputed titan in this arena, it's crucial to understand they are not fighting this war alone. They are simply the lead battleship in a growing armada. Think of companies like the Bitcoin miner Marathon Digital Holdings, which has adopted a strategy of hodling the coins it mines rather than selling them, directly constricting new supply. Remember the splash made when Tesla added Bitcoin to its balance sheet? Each new corporate adoption, whether it's a small private firm or a publicly traded giant, adds another straw to the camel's back. This isn't a disorganized scramble. It's the emergence of a new corporate finance doctrine, a strategic pivot that preaches the virtues of a digital balance sheet. We are witnessing the corporate world's collective response to decades of quantitative easing and monetary expansion, a frantic flight to digital scarcity in an age of seemingly infinite money printing. In the second quarter of this year alone, these institutional treasuries scooped up a combined 159,107 Bitcoin. Strategy, of course, led the charge as the largest corporate holder. But the trend is clear. The big money is here, and it is hungry. According to data from Bitcoin treasuries, there are now a staggering 3.5 million Bitcoin held in institutional treasuries. That's more than 16% of the total possible supply of 21 million Bitcoin already locked away in corporate and institutional vaults. This is what is driving the theory of an impending supply shock. Think of it in the simplest terms of supply and demand. The supply of new Bitcoin is fixed, predictable, and decreasing over time thanks to the halving. But the demand, fueled by this new wave of institutional giants, is explosive and accelerating. When demand outstrips supply so dramatically, prices have only one way to go: up, potentially parabolically up. These companies are effectively acting like giant sponges, soaking up every available Bitcoin on the market at a rate that is fundamentally altering the playing field. This brings us back to that chillingly brilliant concept, the synthetic halving. Let's break down the math provided by Adam Livingston because it is truly mind-boggling. Bitcoin miners, the network's producers, collectively create around 450 new Bitcoin per day. That works out to about 13,500 Bitcoin per month. Now, consider strategy. In the last 6 months alone, they accumulated 379,800 Bitcoin. If you do the daily math on that, it comes out to an average of 2,087 Bitcoin purchased per day. Let me repeat that. The entire global network of miners produces 450 coins a day. Strategy alone was buying over 2,000 coins a day. They were absorbing more than 4.5 times the new daily supply. Livingston's quote now hits with the force of a freight train. Strategy has accumulated 379,800 in the past 182 days. That's 2,087 BTC per day, far outpacing the miners. This isn't just investing. This is a strategic cornering of a global asset. It is a deliberate and aggressive campaign to own a significant fraction of the entire network. This leads to Livingston's ultimate forecast, a prediction that sounds like something out of a science fiction novel. He believes strategy is on a path to become the financial superpower of the future. What does that even look like? A world where a publicly traded corporation holds more economic power stored in a decentralized asset than many sovereign nations. A future where a CEO's decisions about their Bitcoin treasury could have geopolitical consequences. It's a future where the lines between corporation and state begin to blur, all built on a foundation of pure, digital scarcity. Consider the geopolitical ramifications if Livingston's prediction comes to pass. What happens when a corporation's balance sheet, anchored by a non-sovereign asset like Bitcoin, becomes more robust, more trusted, and ultimately more powerful than the economies of some smaller nations? Could strategy begin to offer financial services or stability to countries plagued by hyperinflation, effectively acting as a private, for-profit IMF? Could Michael Saylor's pronouncements from his corporate headquarters carry more weight on the global financial stage than those of central bankers? This is the speculative, sci-fi endgame that the financial superpower theory hints at. Not just a wealthy company, but a new kind of entity that wields sovereign-like power without land or an army. The knock-on effects would be world-altering. It could trigger a global arms race among corporations and nations alike, all scrambling to acquire a piece of the finite 21 million supply. An event that would make the current supply shock look like a minor tremor before the earthquake. So we are left standing at a historic crossroads. On one half, Michael Saylor is a modern-day Midas, a genius who saw the future and placed a bold, world-changing bet that will pay off on a scale never before seen, creating a supply shock that sends Bitcoin to astronomical heights and establishes his company as a dominant global force. On the other path, he is Icarus, flying too close to the sun on wings made of borrowed money, destined to come crashing down and plunge the entire crypto market into a dark and painful abyss. The story of Strategy's Bitcoin gambit is far from over, and we'll be here to cover every twist and turn. Make sure you're subscribed with notifications on so you don't miss our next update on the forces shaping the future of